Every single day, literally trillions of dollars change hands in financial markets all over the globe. Now, it can be really tempting to just stare at those scrolling red and green tickers on the news or those incredibly complex charts and think, you know what, that's just a game for Wall Street insiders, like it's some closed loop that doesn't really matter to the rest of us. But the truth is, the decisions made in those markets affect us all in deeply profound ways. We're talking about the price of the food on your table, the availability of jobs in your city, the interest rate on your mortgage, and even the stability of entire national economies. It's a massive, interconnected puzzle, and today we're going to look right under the hood to see how the whole shebang actually operates. I want to kick things off with this quote from our source material because it perfectly sets the stage for what we're about to uncover. The stock market is not a neutral mechanism. It is a human institution shaped by psychology, incentives, power, and information. You see, we tend to think of markets as these cold, calculating machines that flawlessly price assets based on pure math. But as we're going to see today, they are deeply, fundamentally human. It's an environment that absolutely rewards those who actually understand its underlying mechanics and, well, punishes those who don't. So, the goal of this explainer is pretty straightforward. We are going to strip away the dense financial jargon that usually surrounds this topic. Finance is an industry that's literally infamous for using incredibly complex terminology. And honestly, a lot of the time, that jargon acts as a gatekeeper. It stops the average person from feeling like they can ever truly grasp the subject. We want to completely bypass all of that confusing terminology and reveal the real mechanical reality of the market. And to do exactly that, we're relying purely on evidence and data. We are going to look strictly at what the numbers tell us so we can understand the true power dynamics at play. Because let's face it, there is an endless amount of noise out there when it comes to finance. Opinions, hot takes, talking heads yelling on TV. So anchoring ourselves to the actual, verifiable data is absolutely the best way to cut through all of that static and find the truth. Okay, let's dive into this. Here's our roadmap for today. 1. What is the market? 2. How prices really move. 3. Who actually controls it? 4. The truth about investing. And 5. Market versus real economy. Let's start right at the beginning with Section 1. What is the market? The foundational basics. Before we get into things like high-frequency trading algorithms or complex financial instruments, we need to lay down the absolute basics. We need to clear up the mystery of what exactly is being traded every single day. At its core, a stock is simply a unit of ownership in a company. That is it. So imagine you own a really successful lemonade stand and you want to expand to 100 locations, but you don't have the cash. To raise money to do that, you could sell portions of your lemonade stand to the public. This is often done through what's called an IPO, or initial public offering. By breaking the company into these tiny, individual units of ownership, it lets everyday people and giant institutions alike buy a piece of the pie. It brings this massive, intimidating concept of the global market down to a very simple, tangible unit. Now, you might hear a lot about highly complex predictive models and supercomputers determining stock prices, but fundamentally, the price of a share at any given moment is simply whatever a willing buyer and a willing seller agree to, nothing more. It's exactly like haggling over a rare collectible or a piece of real estate. If someone won't stock for a certain price, well, the price drops until they will. And if someone won't sell it for that price, the price rises until they do. So all of those blinking lights and scrolling numbers you see on financial networks, they're really just real-time records of thousands of these tiny agreements happening every single second. Moving on to Section 2, how prices really move, psychology over rationality. In theory, that agreed-upon price we just talked about should reflect the market's collective, completely rational assessment of a company's future earnings. But the reality? The reality is a whole lot messier, and it has way more to do with human psychology than perfect rationality. Markets just don't move on cold hard facts alone. They move on expectations. And those expectations are heavily driven by two deeply ingrained human emotions, fear and greed. These are the primary drivers of short-term market movement. When greed takes over, people rush to buy, terrified of missing out, and prices inflate rapidly. But when fear sets in, panic takes over and prices crash just as quickly as people rush for the exits, completely regardless of the actual underlying reality of the businesses themselves. The famous economist John Maynard Keynes had this absolutely brilliant metaphor for this psychological phenomenon. He compared stock picking to a newspaper beauty contest from his era. To win the contest, you shouldn't pick the face that you personally find most attractive. If you do that, you're probably going to lose. Instead, To win, you have to pick the face that you believe other contestants will find most attractive. You literally have to step out of your own shoes and guess what the crowd is going to guess. So, the crucial point here is this. Success in the short-term market isn't about knowing what is objectively true about a company's fundamentals. It's about successfully predicting what other people are going to predict. It's a massive, multi-layered psychological game of anticipating the herd's behavior before the herd even knows what it's going to do. You aren't really betting on the business, you are betting on the crowd. Which brings us to Section 3, who actually controls it, the true power dynamics. Now that we know how the market moves mechanically and psychologically, we really need to look at the wizards pulling the levers behind the curtain. Who actually controls this massive system? Who has the real structural advantage? Well, I can tell you it is certainly not the everyday day trader sitting at their laptop at home. The dominant players are institutional investors. We're talking colossal pension funds, massive hedge funds, global insurance companies. They are managing assets in the billions and trillions, and they have entire office towers filled with analysts. Then you have high-frequency traders. They use incredibly sophisticated algorithms and fiber optic cables to execute thousands of trades per second. They're profiting from tiny, micro-penny price differences that exist for literally mere fractions of a second. They make up a huge portion of all daily trading volume. And sitting right at the very top of this entire hierarchy, central banks. And this brilliantly illustrates the sheer scale of the power imbalance. At the apex of market influence are institutions like the U.S. Federal Reserve. They have a level of influence that dwarfs even the biggest hedge funds. When the Fed merely signals its intentions regarding interest rates or economic policy, global markets react within seconds. Think about that. A single, carefully worded sentence in a scheduled press conference can instantly alter the trajectory of trillions of dollars across the entire planet. That is what true market power looks like. Let's move to Section 4, the truth about investing, what the evidence says. So we have to ask the obvious question, right? What does all of this mean for the everyday citizen? If the market is a highly emotional beauty contest, heavily dominated by trillion-dollar institutions and high-frequency algorithms, how on earth can an individual navigate it successfully? Well, the data we're looking at here is perhaps the most dramatic reveal of this entire explainer. The evidence definitively shows that roughly 80 to 90% of actively managed funds actually underperform a simple index fund over a 15-year period. Just let that sink in for a second. The highly paid professionals, backed by those massive research teams, incredibly sophisticated algorithms, and insider access, trying their absolute hardest to pick the winning stocks. The vast majority of them lose out to a dumb fund that simply buys a tiny little bit of everything in the market and just sits completely still. The evidence consistently proves that low-cost, diversified index investing beats active stock picking or trying to time the market. This is true for most people in almost all circumstances. Now, I know this isn't exactly exciting. It definitely doesn't make for compelling financial television to just look into the camera and say, hey, buy a broad index and wait 20 years. There's no adrenaline in that at all. But strictly speaking, it's exactly what the data shows is the most effective, highest probability strategy for growing wealth. Finally, let's zoom out to Section 5, Market versus Real Economy, Bridging the Disconnect. We really need to address what might be the single most dangerous misconception out there when it comes to financial news, confusing the stock market with the actual real-world economy. The stock market is not a straightforward indicator of a nation's economic health. They're measuring two entirely different things. The stock market primarily reflects the expected future profits of a few thousand large listed companies. That's it. The real economy, on the other hand, is about overall employment, the health of millions of small local businesses, wages, and the day-to-day financial reality of average citizens. Just think back to the COVID-19 pandemic. It's a perfect example. We saw the stock markets reach absolutely unprecedented record highs at the exact same time that unemployment skyrocketed, and millions of local businesses were struggling just to keep their doors open. And that disconnect becomes even more stark and honestly a bit jarring when you look at how wealth is actually distributed. To put this into perspective, in the United States, the wealthiest 10% of households own roughly 90% of all stocks. Let me repeat that, 90%. So when you hear on the nightly news that the market had a great day, or that the Dow Jones is soaring and breaking new records, it is absolutely vital to understand that those market gains are distributed very, very unevenly across society. A booming stock market simply does not automatically equate to a booming standard of living for the average person. So let's summarize this journey we've taken today. First, we broke down the basics and saw that stock prices are driven heavily by human psychology, those powerful forces of fear and greed, just as much as they are by cold, hard business fundamentals. We uncovered the reality that the major players in this ecosystem, from colossal institutional investors to global central banks, possess massive structural advantages over individuals. We learned that despite all the noise and the hype on TV, the best evidence strongly favors simple, low-cost, extremely boring index investing over the long haul. And fundamentally, we've clarified once and for all that the stock market is simply not the same thing as the real economy. Our source document leaves us with this incredibly powerful thought. Knowledge is the most durable advantage any investor or any citizen can have. We've stripped away the intimidating jargon, and we've looked at the raw mechanics of the market today. So the question I want to leave you with is this. Now that you see the system for what it truly is, how will you use this knowledge to navigate it moving forward?